Ever wondered if you can profit from a crypto market downturn on Uphold? You know, when prices are tumbling and everyone else is panicking, you're looking to seize an opportunity? That's the allure of short selling. It's a strategy where you essentially bet against an asset, hoping its value will drop so you can buy it back at a lower price and pocket the difference. But when it comes to crypto exchanges, especially one as diverse as Uphold, the ability to short sell isn't always straightforward. Uphold is a fantastic platform for buying, selling, and holding a wide array of digital assets, from cryptocurrencies to precious metals and even some traditional currencies. It's known for its ease of use, transparent proof of reserves, and the ability to seamlessly convert between different asset classes. You can buy Bitcoin, Ethereum, and a host of altcoins, set up recurring buys for dollar-cost averaging, and even earn staking rewards on certain assets. For many, it's a one-stop shop for building a diversified portfolio. However, when we talk about advanced trading strategies like short selling or margin trading, things get a little more nuanced. Short selling in the traditional sense often involves borrowing an asset, selling it, and then buying it back later at a lower price to return it to the lender. This usually requires a margin account, which allows you to trade with borrowed funds. So, can you short crypto on Uphold? The direct answer, in the typical sense of directly shorting an asset through a margin account on Uphold, is generally no. Uphold does not directly offer margin trading or traditional short selling capabilities for cryptocurrencies. Their focus is more on straightforward buying and selling, along with features like staking and conversions. However, this doesn't mean you're entirely without options if you believe a crypto asset's price is going to fall. The crypto market is incredibly innovative, and while Uphold might not offer direct shorting, there are often indirect ways to achieve a similar outcome, though these methods would typically involve other platforms or different types of financial products. One common way to short crypto indirectly is through synthetic assets or derivatives, which track the price of an underlying cryptocurrency. Platforms that offer these products allow you to take a short position, meaning you profit if the price of the underlying asset declines. While Uphold itself doesn't offer these specific derivatives for general crypto shorting, it's worth noting that they do list Universal Market Access, UMA, which is a decentralized platform that allows users to create synthetic assets, including those that can be used to go long or short various financial instruments and cryptos. This isn't Uphold directly facilitating the short, but rather providing access to an asset that can be used for such strategies on a different protocol. Another strategy, though not true short selling, is to convert your crypto into a stablecoin or fiat currency if you anticipate a significant price drop. This effectively shorts your exposure to the volatile crypto asset, as you're holding something stable while the crypto asset falls. Once the price has dropped, you can then convert your stablecoin or fiat back into the crypto asset, acquiring more units than you had previously. This requires careful timing and carries its own risks, but it achieves a similar goal of profiting from a downward movement without engaging in traditional short selling. It's also crucial to understand the risks associated with any strategy that aims to profit from price declines. Predicting market movements, especially in the highly volatile crypto space, is incredibly difficult. Short selling, even when available on other platforms, carries the risk of unlimited losses if the asset's price goes up instead of down. This is why many platforms, including Uphold, might opt for simpler trading options to protect their users from these heightened risks. Ultimately, while Uphold is a robust platform for managing your crypto assets, direct short selling capabilities in the traditional sense are not a primary feature. If you're looking to actively short cryptocurrencies, you'd likely need to explore other exchanges or decentralized finance, DeFi, protocols that specifically cater to margin trading and derivatives. Always ensure you fully understand the mechanics and risks involved before engaging in any advanced trading strategy. With that said, thanks for watching, and until next time.